Yan Liang is an associate professor of economics at Willamette University in Oregon. She focuses on economic development, especially in China. Professor, what are the realistic expectations from talks between President Xi and President Trump? Is there a chance for significant breakthrough? I mean, what has really changed since talks fell apart last month?
This is a great question. I think people cited Mnuchin to say that we're 90% close to reach a trade deal and they would just have 10% more to go. But I think we have to read that message in a cautiously optimistic way because we heard almost exactly the same message back in May, and yet trade talk came to a stall. So I think I share with the majority of the market expectations, which is I don't think there will be any escalation of the trade tension, and yet I don't expect any resolutions from two presidents meeting. I think the most likely outcome and the best outcome is that these two presidents may sign some sort of good faith agreements to jumpstart the trade talks again. And between the trade talk broke down to now, there are really not much positive changes, I would say. So we're all just hoping that there will be a truce on the tariff hikes and both sides will resume trade talks.
Can you explain to us how tariffs work exactly? President Trump seems to think his tariffs are a direct tax on Beijing. He has repeatedly said things like, China's now paying us billions of dollars in tariffs, but that's not really how tariffs work, is it?
Absolutely not. I think we are totally right on this. By most of the research, it has been shown that the tariff revenues were mostly, collected by Trump was mostly borne almost entirely by the U.S. importers. So some of those higher import costs were passed on to U.S. consumers. For example, in the case of washing machine, the 25% tariff hike on washing machine translated into 25% higher washing machine costs for U.S. consumers. But right now, most of the tariffs are still borne by U.S. importers in the form of thinner profit margin. But that cannot last long, cannot last forever. So eventually, the U.S. consumers would foot the bill. Granted, yes, the tariffs is going to reduce some imports from China. And yet right now, I think most of the effects were the so-called trade diversion, which is that Chinese imports to the United States was declining, and yet the U.S. imports from other countries has been on the rise. So jobs are still not coming back to the United States as President Trump would like us to believe.
How concerned are you about the impact on stock markets around the world, on the global economy, if in fact, as you said, these two leaders may just declare a ceasefire and agree to keep talking, but there will be really no resolution?
Right. I think momentarily, the market will react positively to a truce. So I think the stock will rally in the next few weeks or months even, if there is some positive news come out from this meeting. And yet down the road, I think there's still very tough and uncertain trade negotiations between the two countries, because now it's not just the trade tensions per se, but it involves technology, involves national security, it involves a lot of structural changes, as President Trump put it. So I think there are a lot of tough negotiations down the road, and that would definitely affect both countries' stock markets and the broader economy and the global economy as well. But at least I think a tariff truce that is likely come out from this meeting would be a temporarily positive news for both countries, for businesses and consumers, and for the global economy as well.
All right, we'll leave it there. Professor Yan Liang, thank you so much.